Ben, there's been a lot of talk about a housing bubble, particularly, from the Fed, from all sorts of different places. Can you give us your view as to whether or not there is a housing bubble out there?
Well, unquestionably, housing prices are up quite a bit. I think it's important to note that fundamentals are also very strong. We've got a growing economy, jobs, incomes. We've got very low mortgage rates. We've got demographics supporting housing growth. We've got restricted supply in some places. So it's certainly understandable that prices would go up some. I don't know whether prices are exactly where they should be, but I think it's fair to say that much of what's happened is supported by the strength of the economy.
Tell me, what is the worst case scenario? So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis. So what I think is more likely is that house prices will slow, maybe stabilize, might slow consumption spending a bit. I don't think it's going to drive the economy too far from its full employment path, though.
So would you agree with Alan Greenspan's comments recently that we've got some areas of the country that are seeing froth, not necessarily a national situation, but certainly froth in some areas?
You can see some types of speculation, investors turning over condos quickly. So those sorts of things you see in some local areas. I'm hopeful that, and I'm confident, in fact, that the bank regulators will pay close attention to the kinds of loans that are being made, making sure that underwriting is done right. But I do think that this is mostly a localized problem and not something that's going to affect the national economy.
This scenario envisions that consumer spending, supported by rising incomes and the recent decline in energy prices, will continue to grow near its trend rate, and that the drag on the economy from the housing sectors will gradually diminish. The motor vehicle sector may already be showing signs of strengthening. After having cut production significantly in recent months in response to the rise in the inventory of unsold vehicles, automakers appear to have boosted the assembly rate a bit in November, and they have scheduled further increases for December. The effects of the housing correction on real economic activity are likely to persist into next year, as I've already noted. But the rate of decline in home construction should slow as the inventory of unsold new homes is gradually worked down.
There's plenty of liquidity out there. He did not sense a lack of liquidity in the market. And he said we're monitoring the markets, but didn't really make any clues. So he went as far as he had to go, but not further.
He also calmed the fears about the subprime market, which were rippling through Wall Street yesterday, and said we're taking a look at it, but right now it doesn't seem to be an issue, but we're watching it, certainly.
Yeah, that's exactly right. So let's first take a listen to what Ben Bernanke had to say about the economy.
So we expect moderate growth going forward. We believe that if the housing sector begins to stabilize, and if some of the inventory corrections that are still going on in manufacturing begin to be completed, that there's a reasonable possibility that we'll see some strengthening of the economy sometime during the middle of the year. Our assessment is that there's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy, and the lending side of that still seems to be healthy.
Please carry on.
Well, I'm just stunned that an adult would say some of the things they say in Washington and expect people to believe them and to listen to them, especially Mr. Bernanke. Mr. Bernanke, who's been wrong every time he's opened his mouth in the 7 or 8 years he's been in Washington. You know, if I came on your show or came to Reuters every month for 7 or 8 years and I was always wrong, never right, you probably wouldn't invite me back anymore. And yet people still invite him back.
Well, he does run the Fed, so...
I still wouldn't, well, first of all, I'd get rid of the Fed, but second, if you can't do that, I certainly wouldn't listen to him.
So we were all listening to Mr. Bernanke over the weekend when he made some pretty strong remarks to 60 Minutes, in particular suggesting that there will be more quantitative easing to come if necessary. What's your view on that?
I don't have a TV, so I didn't see it, but I did read about it on Thomson Reuters.
Of course, your only news source.
I was dumbfounded. you know, the first time that they printed all that money and spent all that money was beyond comprehension. And the fact that they're doing it again, you remember, Chris, a year ago at this time, they were talking about how they were going to be withdrawing all that excess money they'd thrown into the system. Here it is a year later, and they're talking about putting even more into the system. Why do you listen to him?
Well,
I mean, he's
let me
first of all,
pretend
no, I know where it is because he's got $600 billion to put into the system. I would listen to him too, but it is not good for the world. It's not good for America.
Now, let me play devil's advocate here. Ben Bernanke says he has to do this because unemployment is so high in the United States, and he doesn't see an inflationary threat. Why is he wrong?
Why is he wrong about it? You shop probably, or maybe your butler does your shopping. I don't know.
My husband will be happy to be called my butler.
Okay, well, if you shop, everybody in this room knows prices are going up of everything. Education, tolls, taxis. I mean, I took the taxi in here. I'm telling you, the prices of everything is going up. Food prices are going up. Insurance, everything, all these prices are going up. He says there's no inflation because, first of all, he doesn't know, and second, the numbers he uses, he relies on the BLS, the Bureau of Labor Statistics. Well, those numbers are fraudulent numbers. Those numbers
fraudulent numbers?
Yeah, fraudulent.
That's a strong
You can write that
word.
down. Wait till I use really strong words. Those numbers are sham. Something like, I don't know, what is it, 20 to 40% of the numbers, depending on how you look at them, are based on housing. Now, when housing was going up, they said it doesn't count, and now that it's going down, they're throwing that in there. But the prices of everything, have you bought any tin recently? Have you tried to buy any cocoa recently, any sugar recently, any rubber recently? The prices of everything are going through the roof, and they say they're not.
You know, we hear that in the future we're going to have a better economy, and everybody hopes so, but it's hard to believe. It's hard for me to believe anyway, because I look back on our past 3 years, and what Congress has done and what the Fed has done, we've literally injected about $5.3 trillion. And I don't think we got very much for it. The national debt went up $5.1 trillion. Real GDP grew less than 1%. So I don't think we've gotten a whole lot. Unemployment really hasn't recovered. We still have 7 million people that have become unemployed. And one statistic that is very glaring, if you look at the chart, is how long people are unemployed. The average time used to be 17 weeks. Now it's nearly 40 weeks they stay unemployed. So nothing there reassures me. And also, when we talk about prices, we're always reassured there's not all that much inflation, and we're told that they might start calculating inflation differently with a new CPI. Of course, we changed our CPI a few years back. There's still a free market group that calculates the CPI the old-fashioned way, and they come up with a figure, in spite of all this weak economy, that prices have gone up 35%, 9.4% every year. And I think if you just went out and talked to the average housewife, she'd probably believe the 9% rather than saying it's only 2%. So I would say what we have been doing isn't very reassuring with all this money expenditure. But my question is related to the overall policy. Spending all this money hasn't helped, and yet many allies that would endorse so much of what's been going on, whether it's the Fed or the Congress, they recognize that consumer spending is very, very important, and they concentrate on that. But the $5.1 trillion didn't go to the consumers. It went to buying bad assets. It went to bailing out banks. It went to bailing out big companies. And lo and behold, the consumer didn't end up getting this. They lost their job, and they lost their houses and mortgages, and they're still in trouble. But my question is, if you took that $5.1 trillion and said that consumer spending is good, you could have given every single person in this country $17,000. Why is it the program of both the Congress and the Fed to direct the money to the people who have been making a lot of money, instead to the people who, if you argue that the consumer needs to spend the money, I obviously don't advocate this, but I would suggest you know, maybe it could have worked better. It couldn't have worked any worse. But what is the reason we direct it toward the banks and the big corporations, too big to fail, and we don't pay that much attention to the consumer if it's true, and I don't know if you agree with that or not, that consumer spending is an important issue?
Well, it is an important issue, Congressman, but you're mistaken in saying that the Federal Reserve has spent any money. You say $5 trillion. We have lent money. We have purchased securities. That's not buying, that's not dissipating, you know, the money. We've gotten all the money back. As an article over the weekend by Alan Sloan showed, in fact, the Fed has been a major profit center for the U.S. government. We've turned over profits in the last 2 years of $125 billion. So we are not costing any money in terms of budget deficits or anything like that.
I hate to interrupt, but my time is about up. But I would like to suggest that you say it's not spending money. Well, it's money out of thin air. You put it into the market and you hold assets, and the assets aren't, you know, they are diminishing in value when you buy up bad assets. But very quickly, if you could answer another question, because I'm curious about this. You know, the price of gold today is $1,580. The dollar during these last 3 years was devalued almost 50%. When you wake up in the morning, do you care about the price of gold?
Well, I pay attention to the price of gold, but I think it reflects a lot of things. It reflects global uncertainties. I think the reason people hold gold is as a protection against what we call tail risk, really, really bad outcomes. And to the extent that the last few years have made people more worried about the potential of a major crisis, then they have gold as a protection.
Do you think gold is money?
No.
Christina, I have to say this. By their deeds you shall know them. Anybody that would believe one word that Bernanke says really has to have their head examined. And I'm only saying this because of his track record. This is from 2005. He's asked a question. Tell me, what is the worst case scenario if we see, in fact, real estate prices actually come down substantially across the country? Bernanke. Well, I guess I don't buy your premise. It's pretty unlikely possibility. We have never had a decline in house prices on a nationwide basis. 18 months later, in the midst of the subprime fiasco, he's asked about the problems. He says there's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seem to be healthy.
In like 10 years, 12 years' time, the US dollar will be like wallpaper.
We are on the precipice of a major economic financial collapse. I mean, what we've just experienced, I mean, that's just the opening act. I mean, the real collapse is coming.
One stimulus package will lead to the next one and to more money printing. And so in 5 to 10 years' time, the real crisis will break out when the whole system collapses. That will be the end.
Eventually, this dollar's going to quit working, and then everybody's going to know what poverty is all about.
Our politicians need to understand why the country is in this shape. It's because of them. It's because of the Federal Reserve and their policies, their regulations that have distorted the free market and that have created this mess. And that if they don't stop doing what they're doing, there's going to be no turning back.
As the fiscal deficit goes up, the interest payments on the government debt also go up. They are now around $400 billion annually. I would think that they'll be around $1 trillion in 5 to 7 years. And so then the government goes bust, but before it does that, it will inflate its way out, or try to inflate its way out. And that won't work. So the next step will be to go to war. The whole thing will collapse.